Welcome back. We've got a situation developing in futures. Take a look at markets right now. The market is expected to open down sharply, down about 100 points on the Dow Jones Industrial Average. This, of course, following yesterday's decision by the Federal Reserve to raise interest rates. Also, on the heels of the news coming out of Bob Mueller looking at obstruction of justice. People are worried that the agenda is getting delayed further. After the shooting yesterday, after the special counsel on the Russia probe. Joining us right now, MacroMavens President Stephanie Pomboy. Stephanie, great to see you. Thanks so much for joining the conversation.
Thank you, Maria. Great to see you.
Do you have that same worry? Do you worry that the agenda, meaning tax reform, healthcare reform, is getting delayed as a result of the issues at hand?
Absolutely. I mean, it's incredibly disappointing and frustrating to watch. I actually thought that the comment that Grover Nordquist made to you on your program yesterday was really scary to me when you kind of tried to highlight the urgency for tax reform, and he had this sort of, if it takes 12 months, it'll be fine attitude. And I think he's kidding himself. The economic data is clearly decelerating, and the Fed is moving forward in the face of it. I mean, I think clearly what we saw yesterday is a Fed that's not data dependent. They may say that, but their goal here is to just stockpile ammunition for the next crisis. And they're going to take every opportunity the market gives them to put another bullet in the chamber toward, that goal. And the problem is that the Fed's track record is really poor on this front. They will continue to raise rates until they precipitate either a financial crisis or a recession.
Well, it's been you that's been pointing out mostly that this economy is not as strong as some people expect, even though we saw earnings up 15% in the first quarter. So do you worry that the Fed raising interest rates is going to basically smash an economic recovery that's just gaining traction?
Yeah, absolutely, Maria. I mean, first off, the data just don't support what they're saying. Economic activity by almost all measures peaked in the first quarter of 2015. Real GDP, real consumption, employment growth all peaked in the first quarter of 2015. And now we have an issue where the credit cycle is starting to turn. You've seen a sharp rollover in bank lending, and delinquency rates are rising. So this has the potential to really feed on itself. What we need is to get that fiscal stimulus through to counteract these trends. And the idea that we can just wait and, give it 12 months for this stuff to get worked out seems to me to be a little bit overly sanguine. I mean, clearly the consumer is under distress. You and I talk a lot about tax receipts, and we got an update on that on Monday with the May Treasury budget detail, and tax receipts from individuals continue to show no growth whatsoever. So on the income front,
wow.
Yeah, whatever jobs we're creating are clearly not generating the income growth that we need to support consumer spending, and yet the Fed continues to hold out this forecast that next quarter the economy will show better growth, and it's just not happening.
Yeah, and this is a story that Dagan has been pounding for months in terms of what interest rates are telling us, in terms of what the credit market is telling us, Dagan.
Right, credit watchers are natural worry warts, right, Stephanie?
Yeah,
if you look at the 10-year yield. And to that point, because the Federal Reserve and Janet Yellen were so cautious for so long, and now all of a sudden they've gotten religion about raising interest rates now in the face of a weak economy.
Say amen, Dagan. I tell you, it's laughable. I told my clients in the day before the FOMC to prepare themselves for the most carefully worded BS, obfuscation and misrepresentation, and that's exactly what we got. We are this month in the 8th year of this economic expansion. That makes it 3 years longer than the average post-war expansion already, and the 3rd longest in history. This is not the point when the economy normally accelerates. The yield curve, as you mentioned, has been telling us this. It actually flattened another 5 basis points yesterday, so the yield curve is now 80 basis points. I mean, if the Fed continues to push forward on this path of raising rates, we could see an inverted yield curve. Clearly, the markets are telling you, or the credit market is telling you that the economy can't handle this kind of tightening policy, that the Fed is already too tight. And that's why I really worry about what Grover said to Maria yesterday. I mean, if the GOP actually feels like they have time to, come together and have these debates, they're missing it. They really need to take action immediately.
How do you explain then the 15% gain in profitability and 8% gain in revenue? What's that all about? Because that's what the bulls on the economy will point to, that unemployment is down, you know, at below 4.5%, profits are up.
Yeah, and I'm so glad you asked that, because we saw there were two factors that really have been supporting earnings. One is the mathematical energy rebound, and the other one, which gets much less attention, is the effect of the dollar. And in fact, if you look at corporate profits, I look at the GDP profit numbers, which, you know, hew more to GAAP standards. You know, they don't have the accounting chicanery that happens within the S&P earnings numbers. And according to those statistics that came out last week, domestic profits are still declining. Domestic profits in the first quarter are down year on year. What we saw was a huge increase from currency translation that's boosting profits from abroad. So to look at the growth in profits and say, see, the U.S. economy is doing fine, is false. The profit growth is not reflective of growth in our economy. It's coming from these currency translation effects and the tailwind of the year-on-year gains in energy prices.
So your most important indicator would be the tax receipts then for us to look at?
I think that's critical in terms of staying on top of what's happening in the near term. But I think the biggest and most important development is the turn in the credit cycle. Because as Dagan mentioned, you know, when the credit markets sniff out a problem, they can reprice risk very rapidly, and the markets can tighten very dramatically. You know, the Fed's been raising rates really to no economic effect, but when the markets start to sense that there's a problem, we could see a massive tightening very quickly, and that's what worries me about this delay on the fiscal side, is that, you know, it wouldn't take much time for the markets to reprice risk, and meanwhile they're dilly-dallying in Washington trying to come up with a tax reform proposal.
All right, Stephanie, great to have your insights as always. Thanks so much.
Thanks for having me.